Chapter 13 covers budgets, operating plans, and forecasts. There's a lot of jargon in business and certainly a lot in finance. We're going to hit a little bit more of that today and with very specific uses of those words. So let's jump in. We're going to cover the operating plan, then approaches to budgeting, followed by roll-ups, what we call roll-ups. Sounds like a fruit snack, but it's not a fruit snack. Then moving to the reporting cycles that we normally see in companies. Finally, with a best practice, a suggestion of how companies might look at changing their existing practices to get better effectiveness. The comic says, particle physics I can do. Filling out the budget templates is impossible. I think that's sometimes the frustration people feel in the departments that are asked once a year to do these tedious exercises. They're wondering, why do I do this? Well, there's a very good reason to do it and to do it very diligently. That's what we're going to explore in this chapter. So we're going to change the phrasing from an operating budget to an operating plan. The reason is that we've always known that a budget should not just be about the spreadsheet or the numbers. It should really be about the plan that underlies the budget. So this is the process that we'd like to employ as our best practice. First, let's assess the current situation and be very honest about it, things that are good and things that are not so good. Then we'll look at our strategic initiatives and objectives that are set by the company at the senior levels, because each of us has a role to play in the overall accomplishment of the goals. Third, we'll look at the performance goals and targets for our specific business unit or our department. Fourth, look at the assumptions that are important in how we view the business, how the business results can turn out, and what are the drivers, what are things we can do that are action-oriented that will then hopefully lead to our success. Next comes the game plan for the next 12 months. This is what I was referring to, the game plans, not the Excel inputs. And these relate down to the very minute areas of what individuals within the group are doing that will affect our creation of the value that we're seeking to create. Next, we'll look at scenarios. As part of our diligence is that we're going to come up with a base plan. But then while we're thinking about it, think of what can go wrong and what can go better than expected. We'll then move to gaining consensus and commitments from senior management and your own staff. If your staff is part of the creation of the budget, the likelihood goes up that it will be accomplished. If it comes from you or from on high, then there's kind of a normal reaction like, oh, it's not my plan. I'm not responsible for it. We don't want that. We want responsibility and feeling that it's my plan to pervade the entire organization. Then we'll develop some key monitoring techniques for the assumptions and the KPIs so that we can use these when we track progress. And it's best to devise those before the year begins. Don't pick after the year begins. You'll be tempted to pick the ones that are flattering. Then we'll look at the annual planning process and how we evaluate it when we're done. When we finish the plan, don't just rush into the year. Step back for a moment and reflect on how it went. Capture thoughts that went well so you can make sure you do it again next year. You may have seen some things you wish you did. Capture them now. So next year, you won't be wishing anymore. You'll be doing. And mistakes or delays in the process should be captured so you can squeeze those out come next year. First step is to assess the situation. We're going to look at 3 levels first, and these are all tools we've seen before, like last chapter. But at the macro level, steeple, look at all the changes that are happening in our environment. I won't repeat them because we saw them again in the previous chapter. Next is industry level. Our friend, the Porter's 5 Forces, could be like a checkbox for us to remember to consider all the major players in our industry. The next part, which is obviously important, is current. What is our goals for this year and longer term? And what are some of the targets that we would like to set for ourselves that will then illustrate and demonstrate that we are actually making progress toward those goals? Step B is let's look at the strategic initiatives for not only the long term, but also the medium term and then next year. And those should all build upon each other. So what are the objectives for the company as a whole? And more specifically, what are they for my business unit? And if I'm a department within the business unit, what is my job to deliver on those specific elements that support my business unit? So just kind of break down from top level to the division level or business unit level down to my specific department. Next step is to establish the performance goals and targets. As far as considerations before setting the near-term goals, what is the strategic plan? We just talked about that. What is our business model? How do our revenues and expenses relate? Then looking at our recent performance and position competitively, and again, be very honest with yourself, goods and bads, and then benchmark. we should take the time periodically to benchmark within the company and comparing the outside entities with our own performance. Finally, we'll look at the objectives for value creation. What are those things we can do that will indicate our movement toward our longer-term goals? What are the goals? Remember SMART: specific, measurable, achievable, relevant, and time-bound, which means there's deadlines, there's a sensitivity and urgency to creation of these plans and delivery of the results. Then, of course, at the end of this, gain consensus. At every point, we want to make sure we're not losing anybody, losing people on your team or losing people above you, that you need their support in order to accomplish your goals. Fourth is, let's look at critical assumptions and drivers. What are the critical assumptions? Specifically, what are the market conditions that we assume will persist? If those market conditions change, we must adapt our plans. Next is, we have a certain base set of assumptions about our competition, what they're doing, how they're pricing, where they're going, where they're emphasizing. If that shifts, it may warrant some reaction from our side. Next is suppliers. What are we hearing from them? Are there plentiful supplies of what we need, or is there a constraint happening? What is happening in the cost of our inputs? Are the costs going up or down, and why? It may necessitate us looking around, shopping, if you will, for additional sources of critical inputs. Then we'll look at downstream from us. Who are our channel partners, and how are their outlook, and how important are we to them? We always want to make it important that them doing business with us becomes very important for them. Next, we'll look at the key business drivers. What is it that if we make this happen, the results will come from those actions? They could be new product development, our ability to anticipate the evolution of a market, designing products that fit, being able to deliver on a timely basis so that consumers can find and buy our product. Next is production. It's great to have a product in R&D, but can you actually make it and in the quantities and qualities that we're going to need to be successful? And distribution. It's great to have products sitting in a warehouse, but how's it going to get from your warehouse to the end users? These are all elements that need to come together in order for us to deliver on the results we're seeking. Fifth is, let's look at a game plan. Again, a game plan, not just numbers. We're going to make sure that these game plans are at our detailed level where the action occurs. Then we roll it up to the senior levels and we move it across the organization so there's consensus on what we're doing and coordination, that things happen with a time dimension to them. And the end result of this are numbers. The end result is, now that we have the plan, it seems to fit within what we're doing with other departments and the company overall. Let's now reduce that into the numbers that will then ultimately be our formalized plan. Six, we'll look at the multiple scenarios. As I mentioned, these are what else can happen. Things that go better, things that go worse. Those are our risks. And recall that our definition of risk is often not only downside, but upside. So downside and upside scenarios, both are things that we will articulate and plan for. What we do know is that the base case is probably not going to be exactly the reality come a year from now. So some of these scenarios will likely be the reality. We just don't know which ones. Then we're going to prepare for that by managing the risks, planning for contingencies, or mitigating the risk through other actions, or insuring the risk if some of these risks can actually be dealt with from insurance or some kind of financial instrument. And of course, contingency plans when and if they do occur. Next is gain consensus and commitment. As mentioned, from the bottom, the top, and your own peer group, let's have consensus that this will work. That tends to energize the organization and also increase the probability of success. Next, let's develop processes before the year begins to monitor external and track internal. As far as monitoring external assumptions, they involve the market size, the growth rate, the segment, the choices. Next is competitive actions. These could be in pricing or distribution or emphasis or key partnerships and alliances. Third is to look at consumer choices. These may be by products in your portfolio or customer products or alternative products. These are all indicators of the future. So these clues that we track will be there way before the financial results are written. Internally, let's track how we're doing with some metrics. They could be project milestones because the end result can be forecasted by looking at how well we're doing with the conduct of the project itself. Are the tasks being tracked and finalized to meet our timing and quality that we seek? Next are production targets. Are we gearing up properly in terms of the tooling, the engineering, the test runs. Ultimately, these will come into fruition when we go live with the production. But we can see way beforehand if things are looking good or not. Third is our pipeline. From not only the early stages of a lead, but how do we get the lead? So all the way from lead generation to lead nurturing to the sales process, ultimately to close sale. All of these things are measurable, and they precede the financial results that we're going to see on a financial statement. So these types of tracking mechanisms and KPIs are really a precursor for the results, and more importantly, they give you an opportunity to intercede if necessary and to escalate problems as they arise. Next, we'll look at the annual planning process when it's over. Before we rush off into starting the year, let's gather everyone together and be thoughtful about how did it go. Let's document the process we just did and make them so that we don't have to reinvent the wheel next year. Next, what worked and what didn't. These are always important aspects for us to capture. Again, we're going to forget it within days of the completion. What were the impediments that we faced? How did we overcome them? What were certain issues that we had to address? Can we address them earlier or not even have the issues? And what are some of the opportunities we see now that it's over with that we could have done differently and better? These are all leading to the effectiveness of the process and a self-evaluation of where we stood this year in order to improve next year. Very similar to the Kaizen we talked about in the Japanese manufacturing techniques. And what is the time span? Can we do it in a shorter amount of time, both in terms of the duration of the project and also the time invested by those involved? And again, capture all ideas for improvement, regardless of what those ideas are. Now's the time to catch them. Second topic, let's look at the approaches to budgeting. There are 4 approaches that can be used. Some are more appropriate than others given the circumstances of what we're trying to budget. The first is the output-input approach, the second being activity-based, third incremental, and fourth the minimum level. First, we'll look at input-output. These are where there's physical units. That's the clearest example of where it would work, where we're making a figure, and that figure has to go through certain steps to get to that end product. We can measure the cost of each product, and therefore that unit approach works. We basically work backwards. How many units of that figurine do we want to make, and what does that cost us to make those? And then that will estimate the cost of manufacturing the figurine. So these are useful when we have things that are tied directly to units. Next is activity-based. We saw activity-based when we looked at overhead allocation, but this what it means is where we have distinct overhead departments that serve others. So activity-based can actually work well when we have a very comprehensive system to use ABC methods. If we don't, of course, let's not use it for budgeting. These things match up. Things we do in action, like practice ABC practices, and then we can budget based on that. So if we use ABC methods for our production operations or overhead management, then by all means, let's use that method when we use it. So we have identified activities using ABC. Let's use that for budgeting. Next is incremental. This is where we say, oh, last year we did $10 million. This year we're growing by 10%, so this year will be $11 million. Does that sound familiar? My guess is some of you have been in budgeting before, have seen this method used. The advantage is we can do this because we have a real number, last year's. We have another real number. We have this year's expected growth. So it's quite objective. We actually see this done in government. Is this okay? No, there's a big disadvantage. Just because it's something you did last year doesn't mean it's right. Just because those activities were taken last year doesn't mean those activities should be continued in the future. Perhaps we will keep some and throw away others. By simply taking a percentage and increasing, that just doesn't work in terms of being that critical. And it violates the approach we're trying to take, is that it's not operations budgets, it's operating plans. And planning is all about the activities, not just the numbers. So avoid this. I would consider these intellectually lazy. Last is the minimum level approach. And this is where there might be a base amount where we know we'll have to have this level base, and then the incremental would go from there. That's one variation of minimum level. The other variation is even more radical, is let's start with a blank piece of paper. Assume we have nothing, and let's build from there. What do we need to do to deliver to the company? And what activities do we need? What infrastructure do we need? And then build it from a blank piece of paper. This is the most pure approach, most tedious approach, and in the end, the most effective approach. So this is a best practice in terms of things where you don't have the ability to go right to the unit, like a manufactured product, or you don't have ABC and ABM, activity-based management practices. If you don't have either of those two in this particular department, let's go to zero-based budgeting. Examples of budgets and how it works in a company are often called roll-ups. This is a term quite commonly used in business, and here's a typical org chart. You'll see that at the very top, everything consolidates. Then below that, we have departments. We're just going to go kind of walk down one of the paths. So let's say we have consolidated and we have a budget for sales. So sales, in turn, is broken into 4 groups within sales. They are the field salespeople, the inside salespeople, the order processing function, and the administration of the sales function. Well, if you're the sales manager, you would be responsible for these 4. But what if you're in charge of inside sales? You'll have a budget to manage. And this is the key, is that budgets should be created not by the high level, but all the way down to the person that is responsible for approving expenditures, spending money, generating money. They should get a budget report each month to see if they're tracking. So if that's the case, they should have the hand in creating their own budget. So this is what we mean by roll-up. If I have someone in charge of inside sales right here, this person should look at the cost of their 4 people, their administration, and come up with a budget for this part of the operation, which in turn rolls up along with their 3 colleagues to the sales vice president, let's say. And that sales vice president would deliver that as the sales cost for the corporation, which in turn rolls up when added to all the other peers at this level to the consolidated corporate level. And this is a very typical structure. It makes sense. Budgeting should mirror your org chart. So a common organizational concept is if you have responsibility, then you should have the authority. And the last piece we'll add is if you have authority, you should have accountability. And this is what is accomplished by using this approach. Budget managers roll up to their next level, and when they present it, it's their commitment that we can deliver this. These results with this price tag. And that's how we roll up all the way to the top and assures, or does the best job we can, to assure the buy-in of all those people in the corporation. Next, we're going to look at how does this work operationally. There's one thing to show an org chart. Hopefully that made sense to you. But we have to translate that into numbers and how those numbers do the roll-up. So we're going to go to Excel right now to show you how this works, where you have inside sales rolling up to sales, rolling up to company. This is a spreadsheet you'll see in the accompanying materials. And the left column here represents inside sales, where if I'm the manager of inside sales, this is what I'm going to deliver to my boss. I'm going to look at what are the labor costs. That's this section here. And the first part of labor is, well, who do you have? What do they cost? So this row here, salaries, is tied to this section down here, which are all the people I have. And it may vary by quarter. I may have a hiring plan where I need more and more people as we progress during the year. This could schedule it out on a quarterly basis. You can imagine if we do it on a quarterly basis, we do it monthly. But let's just stay quarterly just to keep the number columns somewhat manageable. And here we have the people that we have, what they cost, and our salary. The salary amount then is captured up here in a summary. Then we add the fringes and other costs, and ultimately all the other elements that will cost to run my department will feed into this number. Total expenses by quarter and for the year can be captured on one row. That's my budget. I present to my boss, the head of sales. My boss says, okay, this is the inside sales line that came from Larry. And he or she's going to pull from all the other aspects of who are directly reporting to him or her. And that will be part of this total selling expense for the department for the year. And that is fed up the chain to the consolidated results. And that would be consolidated one line. All this work of all the people underneath in the sales organization rolls up into one line called selling expense. And this is what we mean by roll-up. From lowest level to mid-level, or mid-levels, plural, all the way up to the consolidated results. Is logical, and all it does, if you think about what we said previously, this in Excel is mirroring what we're doing in the org chart. So this is how it works. The budgets are approved, and then the year begins, and we have actuals. At the end of the month, we have what are called variance reports. Budget versus actual equals variance. People look at variances. They could be the manager who gets the report. It could be FP&A. It could be the vice president in this case. So budget reports are looked at quite carefully by multiple parties with different levels of responsibility. This hopefully leads to some level of management review and actions if necessary. It's pretty crazy to think of a report that you just get and ignore, hit the delete button on an email, or simply file away electronically or physically and not look at it again until the end of the year. We just expended a lot of effort for no value. So the value of variance reporting is not the report, it's the actions and conclusions that come from it. So that's the end of January. It's in the books. What happens next? We're going to repeat this monthly, February, March, April, etc., all the way through the end of the year. Every month, the same cycle. That's why accounting is so routine. It has to be routine because it spurs a lot of downstream actions. Now, there's another element that's quite common. It's called a quarterly review, and it may lead to forecasts. So let's go back in time, and we'll say we have January, February, March. We've gone through the actuals, the variances, the analysis. Now, at the end of the quarter, we say, now, how did it look for Q1? And how does it look going forward for the rest of the year? Some companies allow quarterly revisions to their budgets. Some companies find that too tedious, and they do it maybe mid-year. Regardless, it is possible, let's just keep it that way, it's possible that a company may take occasion to review and reforecast. And that's what we're showing here is a quarterly cycle, where after every quarter, we've done our monthly reviews. We combine those into a quarterly assessment, which may lead to a better estimate of what the year is going to look like. Then that would lead to a revised budget and forecast, which is then baked into the system. And then thereafter, the reports will use this now revised budget. Now, let's look at an annual level. We'll have January, we'll have 1 month of actual and 11 months of budgeted in the future. February, 2 months plus 10. March, 3 months plus 9, etc. until we get to November, where we have 11 months plus 1. Something looks a little wrong, don't you think? Our radar, the windshield in our driving analogy, our radar now only has 1 month. So I'm sitting here on December 1st saying, oh, I have a projection for this month, but beyond that, I haven't thought about it yet, or at least it's not baked into the process yet. This leads to a desire for a better way. So section 4 looks at the best practice of a rolling forecast. And the author of the book calls this DBO. I don't know why it's OBO, but it's On-Demand Business Outlook as abbreviated by DBO. So these blue boxes represent Q1, 2, 3, 4 for year 1. And what we're doing in a DBO rolling budget approach is at the end of Q1, we have 3 months in the books. And now we have 9 months forward. But instead of saying, oh, well, that's how it goes, we then forecast Q1 of the next year, such that we now have 3 months that were already projected, and now a 4th month that make the total windshield or radar being 1 month ahead of us. So this is like the basic idea of a rolling budget or rolling forecast. We can actually upgrade it even further by taking the occasion to take a look at the 3 quarters that are still out there. And we may know more and reforecast those as well. So there's 2 aspects to this. One is we could just say what's in the budget is in the budget. Therefore, when Q1 is over, let's just do Q1 for the next year. So now we do have 12 months. We have the 9 months as originally forecasted or budgeted, plus Q1 of next year. So we have 12 months worth of information on which to manage the business. But another variant of this, which is really the idea of an on-demand business outlook, is let's take the occasion to also look at the budget that we have for the remainder of the year. So we'll actually take another look at these 3 quarters and freshen those and push out 1 more year, which we had not done yet, which is Q1 of next year. And this is the outcome if we have DBO. Would you like to be able to deliver this to your senior management? We are here in Q3 of a year, and now we're going to forecast what the next 2 years look like in terms of revenue, year-to-year growth, trends by product line. There's a stack bar which show product 1, 2, 3 and shows the evolution of our product line. We could also look at operating results where we have operating income both in dollars and percentages, and cash flow that comes from our business. So we can forecast when we're going to be flush with cash and when we're going to have to be careful because of a tight quarter. And we see the seasonality. We see that in Q4 we have a negative, that's regular, and in Q1 we have a spike in terms of our cash flow. We will also look at expenses, the operating expenses by department, the R&D, marketing, selling, G&A, and year-to-year totals, and then also look at the growth rate and how those change. One of the main drivers in most businesses is headcount. We could graph the headcount. Remember that we had all these statistics from our underlying budgets. And then finally look at the balance sheet. On the left side, we see receivables and inventory. How much in dollars do we have in receivables and inventory? These are working up, they're tying up our money. And they show us if we're being very frugal and keeping things low, or are we letting things spiral? So that's the first graph on the left. Second is some measures of our capital structure, debt and debt to capital. The blue line represents the total amount of debt that we're forecasting. You see it's pretty flat here. And then the orange represents debt to capital, and we see it declining. So this is a good sign that we're reducing the risk in the company by managing our debt stable and by generating profit and not increasing our debt. The impact would be, wow, I'm impressed. I think you would believe that if you were able to deliver these results to your boss at the end of Q1, 2, 3, or 4, an outlook that pushes out for more than just the ensuing months in the remaining budget year, but also out beyond that. Well, I could say you can do it. It's not easy, but you can do it. How? The next few steps show us how, just in a simple Excel spreadsheet. You might not think it's simple. The logic is simple. Let's all agree on that. So I'm going to walk you through how this is going to work. So this is a summary. How does it work? What we have is color-coded. The yellowish color represents the quarters that are actuals. So we're sitting here in this scenario at the end of Q2, where prior we have actual data. Then we have 2 months remaining in the annual budget, and that's in the light blue. And then we have this desire to push things out to next year to kind of forecast beyond the current budget year. This is the idea that we have. Now in green, we may have had a medium-term or long-term set of financials that are in some more aggregated state. So this is an example where we have 3 types of information. We have actuals in yellow, we have remaining years budgeted items in blue, and we have kind of longer term forecasted items in green. And we're going to see that we're going to do a rolling budget. So when we're finished with the process, we'll have visibility for, again, 12 months. First step, estimate revenues. Now I threw another color in here. Why? Because the yellow is the actuals, but now we have purple or pinkish, right? The purplish color represents our forecast for the next quarters, the next 4 quarters, 2 of which have been budgeted, but we're going to look at a fresh look at forecasting anyway, and the 2 are not yet in the budget. So we're going to create and refine budgets that are out there for Q1 and Q2 next year. The end result of this is we're going to have a view of 4 quarters, the best thoughts we have on it, that will show units sold by product line at prices and gross margins. This is the first step. So this is in PowerPoint. Let's go to Excel and see how the guts of this work in terms of the actual spreadsheet. What we see here is the actual Excel of what I had grabbed the photo of. We see revenues, expenses leading to net income, and some metrics on year to year and percentage ratios essentially. So this section here is the income statement. Now we see the colors. This is what we had in yellow, and here we had Q3 and 4 that have been budgeted. Q1 and 2 of next year are not yet budgeted. So what we're going to do is break down into products. So products we see here, product 1, 2, 3, 4, 5, to get to this total products, and then back to product 1. For each of the products, we'll have the average selling price, the product costs, the unit volume, which then, if you just do the math, shows us our expected revenue from product 1, our cost of product 1, and by subtracting the cost from the revenue, we get gross profit, expressed in dollars and in percentages, as in gross margin. So this purplish color represents our best view of the next 4 quarters. Didn't matter that 2 of them were budgeted. We're now looking at the best available information to guide management discussions and decisions. So these set of numbers, you can imagine we're going to roll forward. Next, step 2, we'll look at other cost of goods sold. So at a very high level, we had one kind of estimated gross profit because we had an estimated cost of goods sold. Here we realize that in most companies there are refinements after the actuals have been done and the dust settles. They relate to these items here: cost variances, warranties, royalties, scrap costs, etc. They may or may not have been captured in the cost of goods sold. So here we're doing a fine-tuning of an important number, cost of goods sold. Again, we're going to hop out and go to Excel. Here we see that same tab here is labeled gross margin, and we see the sales and gross margins, which we had forecasted from the simple analysis previously, and we're adding this piece here. This piece is looking at other cost of goods sold that are common, but we have a hard time budgeting them. Therefore, it's best to do this after the quarter is done. So these lead to a total of cost of goods sold, which will be a key number as we move into the income statement. Also notice that we're rolling forward other data that we're likely going to need, such as headcount. So headcount is one of the management items that we're going to be watching carefully. So as we progress, we're going to keep track of headcount. Step 3 is selling expenses. In this step, we're going to look at all the costs to run a sales department. It could be things like people, the salary. Again, similar to what we saw previously, salary on the bottom represents all the individual people in your group and when they start. The salary then rolls up into one number, which we carry forward up here as far as the personnel costs. So these are actuals. This is forecasted for the next 4 quarters. Green we're going to not touch because those are kind of longer term forecasts. Again, let's go to Excel. So this is Excel that represents our estimate of selling costs. It's just very organized, very systematic. It says, okay, let's lay out all our expense categories. And for the one that's so important of salaries, let's have a little subschedule on the bottom saying who do we have, how many people, when are they hired, and how much do we pay them. Those are all rolled up into this rolled number salary. Then we do other costs of people, and then other costs of our department. Now notice this part will change from department to department. If you're in sales, you're going to do travel, have meetings, have materials, you have to contract. These are the types of things we'll have if we're running a sales operation. These roll up into this one row, which again is a key number. And again, we're going to roll forward an estimate of our headcount. So notice a very clear pattern is we do this detailed spreadsheet. So we have accountability back to those people managing these departments, and we're rolling up key numbers into later schedules that will ultimately lead to consolidated results. Step 4, marketing. I'm going to speed up a little bit because I hope you understand the process by now. We're going to systematically go through each department and then estimate their people costs, all the other costs to run their function, and then end up with totals that we can roll forward into consolidation. Step 4 is marketing. I won't even go to Excel. It'll be in the accompanying document so you can see it. But it's a look at the same format. It's people costs broken in below to who's in your department, and then the cost specific, in this case, to marketing. Having advertising, for example, clearly something in marketing that you would not see in sales. Step 5, general administrative. Again, same approach, yet another box in that org chart. We're looking at what does it cost in people, who are the people, when are they hired, and what do they cost, and then here, the items in the operating cost line items for running the general administrative side of the business. Step 6 is R&D. R&D is discretionary. Some companies have R&D because it's key to their business. Any tech company, pharma company will have a lot of R&D. Other companies, like a merchandiser, if you're Macy's or Nordstrom's, you're not going to have a lot of R&D. So this is an example where, of course, they have R&D. Same approach. People costs, and below, who are these people? Operating costs for what they need to do their business. Step 6 then is R&D. Then we roll all that together in step 7. Here I will go to Excel just to show how the linkages work. But at a high level, what do we really want to look at? We want to look at our profits. They could be gross profit, which is the top line, which is revenue minus cost of goods sold. Then we have operating profit, which after all the expenses to run the business, what's our operating profit and percentage. Then after that, we'll look at non-operating items, subtract those from operating to get a pre-tax profit. That is the profit before income tax. Then we have income taxes leading to net income. This is a progression of all income statements. And again, we'll look at how this relates to what we did in Excel. So we have marketing, just the G&A, R&D leading to this row. And this row shows that all those detailed departments are right here. One line per department to roll up into the consolidated income statement. The revenues comes from that early lineup of all our products, adding up the revenues. The cost of revenue is that adjusted number based on our analysis of scrap and warranty repairs. These 4 line items come from one spreadsheet per department to get to departmental costs. And these are other items that we would estimate, perhaps on yet another spreadsheet, in order to get to this roll-up, to get to net income. From that, we could get metrics of total revenue, expenses, income, and percentages. What is our gross margins, and what is our expenses as ratios of revenue, common size analysis. So this is a spreadsheet that is the first piece that consolidates information from all the underlying departments. Obviously a very important sheet in the Excel document because it rolls up and accumulates all the results of the underlying departments. Next is a balance sheet. We have focused more on the income statement, but we can, through using some assumptions, generate a balance sheet. Those assumptions, some rely on relationships between the income statement and balance sheet. We can actually estimate the relationship between an income statement item like sales to a balance sheet item, receivables, and you know to be days sales outstanding for the company. We do this for receivables and inventory quite directly. Some are not so easy, like capital expenditures. The income statement doesn't really show us capital expenditures. So this might be estimated outside of the income statement projection. The last item are financing decisions. We're not looking at what kind of debt we take on, what kind of interest we put on. I alluded to that when I said we don't have interest expense on that projection. So a third set of supporting information to bolster the balance sheet projection would be things on financing, debt, equity, dividends, interest paid. So let's look at this in the Excel document. We see in Excel that we have now the yellow representing the actual, the pink or purple representing our projections. And these are some of the relationships in this column that help us estimate as a percent of sales, what is the balance sheet that would correspond to that level of our business. Some of these items are added explicitly from some outside source, such as capital expenditures. So we see here PP&E, and it's growing over time. We did not forecast that growth. That it will come from a separate schedule. We'll also see that there's evidence of financing activities, such as what are we doing in dividends and also in any debt repayments. The balance sheet covers pulling forward things that are related to the income statement and then adding to that things that relate to the balance sheet and not directly from the income statement. So that wraps up our DBO spreadsheets, and you might want to look at these spreadsheets a little more closely at your leisure. We'll also do a little bit of recap of this in our workshop. Summarizing this chapter, we have an operating plan. Notice we didn't say operating budget. I may call it operating budget because we use that term more frequently, but we want to think of it as a plan with actions and specific measurables and a lot of other thought than simply putting a number in a cell in a template. Second, there are approaches to budgeting. We know that if we can do it on a unit basis, that's great. If we have ABC, that's great. But remember, don't be lazy. If you don't have the unit-based or ABC, then let's use a zero-based approach to budgeting. Third is budgets roll up. Budgets should be organized and their spreadsheets organized based on the organizational chart so that we can roll up from levels of responsibility where we manage departments up to divisions, up to groups, and up to consolidated results. We also looked at normal reporting cycles, monthly reporting for budget versus actual and variances, quarterly reviews, perhaps leading to forecasts. These are typical processes we use. Then we looked at a best practice of on-demand business outlooks, where these provide long view in front of your windshield, namely 12 months minimum, with real information based on the latest thinking. So this approach will lead us to more current assessment of the company and more comfort that we put thought into the direction and the actions necessary resulting in the forecast that we're coming up with from the DBO. It's a lot more work, but the work is valuable because we saw those graphs. They're beautiful to be able to have that kind of foresight into the outcome of your business. So my conclusion is DBOs are very powerful. We don't see them in every company. In fact, it's rare that you see this level of planning precision, but it is a model that we will examine and perhaps implement in our businesses.